It's very much an opportunity for me to share what we've done in terms of how we approached climate scenario analysis, and in particular how we've attempted to integrate that into the investment process. It is not over. The journey is not over. There's still more to do, and I will tell you what we have done and what we are still planning to do. I have a few slides that I put together. I'm not sure if we can put them up on the screen so that we can navigate through them. But basically, just I will very quickly, my role at USS, I'm head of investment strategy. So my team looks after the asset allocation of the DB, so the defined benefit and defined contribution section of USS. As you probably all know, USS is the largest private sector pension scheme in the UK, with over 500,000 members, and covers the higher education sector, so all the UK universities. We are a hybrid scheme, but the majority of the assets are in the DB section, and unusually for the UK context, we still have an open DB section. So we have a dedicated in-house manager. I think the governance arrangements are quite important, as I'll come to explain in this context. So we have a dedicated in-house manager, and we run approximately 2/3 of the assets internally and outsource to third-party manager the remaining third. So we'll start with really how we approached scenario analysis for the first time. This is back to 2022. We embarked on our first attempt to carry out scenario analysis focused on climate. This was very much to satisfy the TCFD requirement, but it gave us really an opportunity to think how we would approach climate scenarios. We, in the end, opted for a fairly traditional approach, but we were not impressed by the results. So it was a very helpful process to understand the shortcomings. So we had many discussions in the various governance bodies, at the board, at the investment committee, and really focused on the shortcomings, not so much the results, but what was missing from this framework. So as you might recognize, is a fairly traditional approach. It is focused on long-term climate pathways, and the main output is a comparison of expected return across different scenarios, very much focused on long-run return assessment. And as it came out in our discussions, with mainly simplified assumption on how physical risks are treated and how the transition is modeled. So in the end, when we presented these results in our TCFD report, there was a much longer section describing the limitations as opposed to the section that described the results themselves, which obviously you can see, it is ultimately a comparison of returns and between the most optimistic and the most pessimistic scenario. The assessment was that there is only a 70 basis point difference over 30 years per annum. So this was a starting point. And it's fair to say that we are not the only one to argue that there's much to be desired. That the traditional approach could be improved. Traditional approach to scenario analysis could be improved. If we move to the next slide, I've taken a few comments from the recent review the pensions regulator has carried out on the use of climate scenario analysis among UK pension schemes. And some of the points that were made in the review really resonate, and they're quite similar to some of the points that came out in our discussion internally. And in particular, quantitative analysis, there is a risk of over-reliance on quantitative analysis. So that expected return comparison over 30 years, there's a risk that there is too much anchoring on that precise estimation. And alongside that, there is a risk that not enough emphasis is put on the limitations and all the simplifying assumptions that, of course, drive that answer. So this very much we found was very aligned with the results of our discussions, and really was our discussion back in 2022 prompted us to think about a new framework, a new approach. And this was really the starting point for what we have done last year in the collaboration with the University of Exeter. So if we move to the next slide, I'll just briefly remind or outline what the framework that we developed actually looks like. So first, the focus is shorter term horizon, rather than trying to model the complex interaction between climate and the macro system over the next 30 years. We prefer to focus on a shorter horizon, 2030, where some of the uncertainty can be sort of better understood. And the second point that we really focused on is proper integration of the short-term physical risks. Most of the traditional modeling framework that we've seen use very simple assumptions to assess physical risks. Usually it's a simple relationship between GDP and temperature changes. We really wanted to bring in the perspective of the climate scientists to understand the impact of physical risks. And also, I mean, very importantly, we didn't want to focus on climate in isolation, but really try to understand, as we model a shorter term scenario, understand climate and the transition in the context of everything else that is happening in the world, in the context of the evolution of the macro picture, in the context of some of the other big picture drivers, like the geopolitical dynamics, for example, or the progress of technology. So this really gave us a framework where we focus on two key dimensions that really help us differentiate between 4 different scenarios. And the 2 key dimensions are what we call the market dynamism, so how quickly market solutions emerge to solve the climate challenges, how quickly new technologies are deployed and discovered. And the other dimension is the degree of policy coordination and policy focus on solving the climate challenges. So really, the combination of these 2 variables give us 2 neat 4 alternative scenarios. And this really was the framework that we developed, and the framework that was explained in the No Time to Lose report published in September last year. So this is really the framework of the narrative scenario. We have these 4 alternative narratives. Now the next question is, how do we actually use this? How do you move away from just a tick boxing exercise to satisfy TCFD requirements and really integrate this framework into an investment process? So I'll take just a step back to explain that this is easier in a context where the governance framework enables to incorporate scenario into the decision-making process. There is certainly a governance challenge to be able to fully incorporate this approach. So if we move to the next slide, I'll explain. We have spent a lot of time over the last few years at USS on the investment governance framework. We have reviewed the fundamentals of how investment decisions are taken, how we think about risk, and how we evaluate performance. And so we moved away from a more traditional investment governance framework, and more traditional investment governance frameworks tend to be focused on one measure of risk that tend to be fairly backward looking, and a performance assessment relative to a benchmark. And this was very much our framework as well. We had the reference portfolio, and the delegation to the in-house fiduciary manager was based on an outperformance target, outperforming versus the reference portfolio. And risk was very much modeled through one risk measure. It was very much anchored around history. In our new framework, we embraced a more holistic philosophy for risk management. Rather than focusing on one metric, we really look at risk in its multiple dimensions, and climate is one of the areas that we specifically focus on, recognizing that especially a backward-looking metric cannot give you the full picture. You need to think about how the system could evolve in the future and bring different perspectives to the risk assessment. And at the same time, we move to a performance assessment that, rather than looking at a simple number, the alpha relative to a benchmark, we look at a number of different criteria. We look at integration of climate consideration into the investment process. One of the criteria that are looked at when it comes to judging the performance achievements of the in-house fiduciary manager. So that is sort of this more holistic framework. I think it's very important to enable the fiduciary manager to take a truly long-term focus, a forward-looking perspective, and ultimately be able to incorporate the scenario analysis into the process. And if you move to the next slide, this really shows in more detail how the new investment governance arrangement works. At the top, it's the risk appetite, risk capital of the trustees, which then gets cascaded down and really helps assess the perimeter and the constraints in which the investment manager, the in-house investment manager, can operate. And the framework really ensures that there is what we call the golden thread, a consistency between the overall objectives and the implementation by the investment manager. So there is that penultimate step, the investment management agreement, really is focused on setting a perimeter, not giving a benchmark, setting a perimeter, giving a set of requirements and a set of constraints in which the investment within which the investment manager can operate and actually design and manage the actual investment portfolio. So there is, compared to a more traditional framework, there is a more extensive delegation. And more importantly, the strategic asset allocation decisions are delegated to the in-house fiduciary manager, as opposed to be set by a non-executive body like a board or an investment committee. So that is quite different from many other institutional investors. But I think this is important and is an important enabler for integrating such a complex dynamics like the climate scenarios. So if I move to the next slide, I will now get into a bit more detail in terms of what I actually mean in terms of integrating scenario analysis into this process and within the delegation framework that I just explained. So our first step in the integration is the analysis of the long-run drivers. We think about this is what we call thematic horizon scanning, looking at the future and try to understand what are the big drivers of markets and the macro picture of the next 5 to 10 years. Scenario analysis comes next, which I've already explained. Try to put all these drivers into the context, how the world could shape under different assumptions over the next few years, and all of that informs our prospective investment outlook. So with big picture themes like the energy transition, clearly it's a very important one, but it's not the only one. And alternative scenarios, we can derive an investment outlook that is not anchored in history, is really thinking about what might happen in the future. From the investment outlook, we assess the risk and opportunities across different asset classes, and then incorporate that into the design of our strategic allocation, and also the design of specific mandates. So our delegation framework enables us to blur the line between asset allocation and mandate design. So some implication of the scenario analysis might be better reflected into how we invest within an asset class, as opposed to the allocation to the asset class. And there is enough flexibility in the framework to be able to do that. So if we move to the next slide, this is an overview. When I talk about big picture themes, this is an overview of the themes that we have looked at in our horizon scanning, we call it. And the energy transition is an important one, but there is a number of other macro drivers that we focused on. Clearly, in the pace of innovation, technology, deployment of artificial intelligence is an important big macro theme. Geopolitics is another theme where they will really shape the landscape. And there is obviously a very close interaction with all of these themes, and this is what the scenario analysis attempts to capture, not just looking at one theme in isolation, but understand how the world could play out under different assumptions when you bring them all together. So if we move to the next slide, one important aspect of how we approach portfolio construction. So when I described a framework where we develop an investment outlook from an assessment of macro drivers, really very much forward-looking. And this is a different approach from the more traditional approach. Is really focusing on coming up with expected returns for different asset classes. So it really boils down to coming up with expected returns, and then portfolio construction tends to be anchored around some kind of optimization model. So what we have done instead is, again, similar to our investment framework, a more holistic approach, less anchored on precise estimation, and try to incorporate different criteria. This is what we call a portfolio quality assessment. So we obviously look at risk and return prospects, but we incorporate a number of other factors in our assessment, and rather than finding a simple or a complex quantitative toolkit to give us the answer, we use quantitative analysis to filter, to assess the range of feasible portfolios, and then compare alternative candidate portfolios across multiple lenses. And besides the more traditional ones, we look at the impact, the big picture macro drivers, the horizon scanning. So we compare alternative portfolios in terms of how much exposure would this portfolio provide to some of the themes that we've identified in our forward-looking assessment. But we also spend time thinking about portfolio resilience, which portfolios would be more resilient to shocks. And rather than modeling a shock from history, we try to anticipate what kind of shocks could happen in the future. And also, we assess what portfolio would give us most flexibility to make adjustments. If we are thinking about a fairly volatile future, as some of the scenarios actually imply, having the flexibility to make adjustment and not being forced seller becomes very important. So all of that has to be an art and a science. There isn't a perfect model that can capture all of these criteria. So it's important that there is a qualitative step when some alternative potential portfolio allocation are compared, and the impact of these factors is assessed to ultimately come up with a final conclusion. So if I move to the next slide, I will then give an example. This is a very simple example. Simple example of how you could take the scenario analysis and compare different portfolio strategies. This is simplistic because there is but that's kind of a first step. So here there are three different asset allocation strategies. Very, very simplistic. The difference between the three are the allocation to growth assets, the allocation to liability matching or hedge ratios, and the allocation to credit assets. These are the three key dimensions that we think about as we build the asset allocation of our defined benefit fund. So when building the asset allocation for the DB fund, we essentially need to balance out the need to reduce exposure to liability risks and also the requirement to generate a return from growth assets. So here, when you compare across the different scenarios, you can see that, for example, a strategy with a lower allocation to growth assets would not provide sufficient return potential in most of the scenarios. And at the other end of the spectrum, a strategy with a much higher allocation to growth assets would only provide some marginal benefit in the more optimistic scenario, and of course will suffer if the most pessimistic scenario were to play out. So this simple example help us to zoom into a strategy that strikes the right balance, which is in this case strategy B, struck the right balance between liability matching and exposure to growth assets. Now, this is very simple. If we move to the next slide, there are obviously more complex considerations. So when it comes to the full analysis of the strategic asset allocation, we of course make it more complex than these simple building blocks from the previous slide. The anchor that we use is called strategic portfolio. The strategic portfolio is, in essence, our medium-term desired allocation across the full spectrum of investment opportunities, and we can access private markets, public markets. So this is a much more complex set of decisions than just choosing between liability matching and growth assets. But when we make this kind of decision at a much more granular level, there are a number of considerations that from the scenario analysis that have been incorporated. This is very much live. We have approved the new strategic asset allocation in June, and these slides really summarize some of the key themes from the scenario analysis that we have incorporated. All of the scenarios point towards inflationary pressures and inflation volatility, and we have therefore reflected that into greater emphasis on inflation protection in the strategic allocation. There are, in particular, two of the scenarios point us toward opportunity from the deployment of new technologies. So opportunities that comes as a result of the energy transition and the climate challenge that could potentially give us a positive spin on productivity and growth, which obviously have been lagging over the last few years. So we have attempted to capture that by skewing our allocation towards the growth end of the spectrum, to looking at a dedicated growth strategy that tries to identify the potential winners from new technologies and from a higher growth environment. That's really an example of where you blur the line. This is not the overall allocation, but how you choose to express the allocation within growth assets. That's really trying to capture these potential opportunities. We've also focused on portfolio resilience. We know that there are downsides and there are important downsides, and there is a very negative scenario that we think is plausible. So we focus on strengthening portfolio resilience. One way that could be done is by looking at exposure across different currencies. We have focus on currencies that have defensive properties that can do well at times of stress. And so that's kind of one example of how resilience could be strengthened, and again incorporating the more negative scenario assessment. And we also focus on portfolio flexibility, ensuring that there are enough levers that we can pull should market conditions change very quickly, which is again is one of the features of the scenario. So this is pretty much, there's no one silver bullet. But there are many different aspects of the scenario analysis that have been integrated into a strategic allocation. Now, this is what we have done. There is still plenty to do, and I will just conclude in the last slide with a quick overview of some of the before I do that, this is effectively the summary. This is where we've got to. This is a snapshot of the strategic asset allocation of the DB fund, where you can see we have balanced out the need for protection against liability shocks with allocation to growth assets, and really spread across public and private markets. And one of the areas that we will be emphasizing is exposure to infrastructure assets and assets that obviously can benefit from some of the big investment requirements from the energy transition. So within that private growth section of the pie, these are some of the assets that we hold and where we will be looking to deploy more capital. So this is very much the snapshot. There are, at a high level, as a result of the asset allocation review, there won't be a huge change. There'll be probably a slight increase in growth assets and a slight increase in inflation protection, but there will be a lot of changes under the hood within these big building blocks that will be done as a result of the review and incorporating scenario analysis into the framework. So, as I was just alluding before, there is still plenty to do, and in the last slide, I will just give you a sense of what are the next steps. So there is more work to do on physical risks. That is one of the aspects that was looked at in the No Time to Lose, and the work we've done with Exeter. But we are working on really building a heat map to try to understand exposure to climate-related events across different geographies, and how the portfolio is really exposed to potential near-term tipping points. So really leveraging the insight from the expert and understand at the detailed level our exposure across private. This is one of the few examples where in private markets it's a bit easier because we know where the assets are located. In public markets, you need to understand there's quite a lot of complexity in disentangling supply chains and where operations are located. So that's one important objective. The narratives have to be refreshed. So we're building a framework to refresh the narrative to reflect new events, and also understand how to assess what's becoming more or less likely. We also want to explore sector implication at a deeper level. So we sort of scratch the surface in terms of understanding what the narratives mean for different sectors. We want to understand that better so that we can integrate the scenarios fully in our more bottom-up decision-making, sourcing assets within private markets, or investing within or portfolio construction within public equities. And also, the ambition is to fully align the methodology for top-down scenario analysis and how we look at exposure for single companies and single assets. So being able to understand the exposure of every single holding through the same lens, so understand how a particular company would cope under the different scenario. That we have not there yet, but that's that's the goal. And that is one thing that none of the off-the-shelf solutions or the off-the-shelf models for climate scenario analysis are able to do. There are either focused on the bottom up or the top down. So that is a really important objective. In 2025, we will be refreshing our climate scenario analysis and present that in the TCFD report. So hopefully I will stop here. Hopefully that gives you a brief overview of where we started, where we've got to, and where we're heading in terms of climate scenario analysis.